After a stronger than expected 2025, investors are stepping into the new year with a mix of optimism and uncertainty. Growth is still positive, innovation continues to push the economy forward, and inflation has cooled meaningfully. At the same time, volatility is picking up, and certain parts of the economy are beginning to show real signs of strain. That combination is exactly why today we're taking a clear, grounded look at what to expect from markets and the economy in 2026. For long-term investors, the most important question this year isn't what the next headline will be. It's how to stay disciplined when the environment becomes noisier and the path forward feels less predictable. Hi, I'm Justin Kuntz, Managing Director of Pacific Wealth Management, helping you make good financial decisions through sound management for a secure future. The first thing to understand about 2026 is the economy is still expanding. Growth is slowing compared to the past 2 years, but our base case calls for GDP growth between 1.75 to 2.25%. While that may sound modest, it's still firmly positive and very much in line with what you typically see in a mature business cycle. Consumers are still spending, even though the job market has softened. Inflation has cooled significantly, which gives households more breathing room in their day-to-day budgets. And global growth, particularly in emerging markets, continues to provide a steady backdrop for U.S. exporters. That said, some pressure is clearly building beneath the surface. We're seeing rising delinquencies in auto loans and credit cards, and several large companies have announced layoffs, including Verizon, UPS, and Meta. These stresses tend to be concentrated among lower-income households, though, and while they're worth watching closely, so far, they haven't had or spread broadly enough to push the overall economy into recession. The key takeaway here is that growth is slowing, not reversing, and that brings us to the next major theme shaping 2026, inflation and interest rates. Inflation continues to trend lower, which is good news overall, but the final stretch back towards the Federal Reserve's 2% target is likely to be a lot more challenging. New tariffs, supply chain realignments, and labor constraints tied to immigration policy are all factors that could keep price pressures from falling quickly. The more encouraging news is on the interest rate front. We expect rates to drift slightly lower in 2026, which should ease pressures on borrowing, business investment, and financial conditions more broadly. That said, we don't expect a return to the ultra-low rates from the 2010s. Instead, rates will likely settle at levels lower than where they are today, but still higher than what investors grew to be accustomed to over the past decade. Mortgage rates may also edge down slightly, but that alone won't suddenly restore housing affordability. The broader structural challenges in the housing market are still very much in place. So, what does this all mean for markets in 2026? We're now firmly in the mature phase of the bull market that began in 2022. U.S. stocks have delivered strong gains over the past few years, and as a result, valuations are elevated and there's less room for error. Seasonal patterns and political cycles also suggest that volatility is likely to be more frequent in 2026. We still believe that stocks have room to grow in 2026, but the path forward is likely to be a bit choppier. Pullbacks may be sharper and day-to-day swings may feel more dramatic. But it's important to remember that this kind of behavior is pretty normal in a late-stage bull market. With that backdrop in mind, I wanted to dive into a few key themes that will influence portfolios in the year ahead. First, consumer strength will likely remain positive, although spending is slowing down. Household budgets are tightening and job growth is cooling. Second, corporate earnings should continue to grow at a moderate pace. Not the outsized rebound we saw after the pandemic, but healthy enough to support long-term valuations. Third, interest rate cuts will likely help lower borrowing costs, though the easing cycle will be more measured than aggressive in our view. Fourth, global demand should remain stable and increasingly supported by the emerging markets, which will help boost U.S. exports. And finally, politics and trade will likely continue to create short-term volatility. Policy shifts are already influencing supply chains and input costs, and election year uncertainty tends to amplify market reactions. Taken together, this environment favors balance and diversification over concentrated bets, and that becomes even more important when we consider one of the most powerful forces shaping markets today, artificial intelligence. AI continues to transform industries and unlock new sources of productivity. Its long-term potential is very real, and we remain optimistic about the value it can create. But at the same time, the investment side of AI is much more complex. Many AI-related stocks are priced for very rapid growth. Expectations are extremely high, which means that even small earnings disappointments can lead to outsized price swings. We don't necessarily view AI as a bubble right now, but we do see it as an area where participation needs to be thoughtful. That means that avoiding overconcentration, staying diversified across the space, and understanding that volatility will likely be higher here than in the broader market. When you step back and look at the full picture, the message for 2026 becomes a lot clearer. The economy is still growing, inflation is moderating, and the markets may remain choppy, but the long-term fundamentals still remain intact. In an environment like this, success depends less on predicting every market move and more on staying disciplined. Balanced portfolios, consistent strategies, and diversified exposure tend to outperform reactive decisions, especially in this mature cycle. The goal here really isn't to guess what's happening next. It's to build a plan that's designed to hold up across a wide range of outcomes.
Maybe one more of this. I think across different market cycles, or?
I'm Justin Kuntz, Managing Director of Pacific Wealth Management. And if you're interested in learning more about building a portfolio that is resilient across a number of different market cycles, check out our other videos and check out our website at www.pacwealth.com. Thanks.